Back to our special coverage, the Federal Reserve voting 9-1 to leave interest rates unchanged today on concerns about the global economic slowdown, low inflation, and recent volatility in the markets. Want to bring in former Fed economist Kevin Hassett and Michael Cox, former senior vice president of the Dallas Fed. Good to see you both, gentlemen. Thanks for joining us. Michael, do you think the Fed made the right decision?
No. I think this whole policy of low interest rates for 7-8 years is exactly what's got us in this economic stupor of low inflation, slow growth, and bad job creation. The Fed is paying banks to hold reserves. Once the Fed raises the interest rate, in fact, bank reserves are about 20 to 25% of deposits today, up from 2/3 of 1% in 2007. And this is an economy which runs on bank lending. Once you raise the interest rate in the economy, you get banks to lend. Once you get banks to lend, the money supply expands more fast than it has been. And then the prices start to rise. And with the lending, more economic improvement comes and more job creation. So the paradox here, it always happens in a period of low interest rates for a long time, is the so-called Keynesian paradox of the liquidity trap. The Fed needs to raise interest rates, and that is the way you get the economy going.
Exactly what Charlie Gasparino has been saying this afternoon. Can you give us a sense? You're a Fed advisor and have sort of been there at meetings before. How did this go down? I mean, 9 folks saying no rate hike and one, Jeffrey Lacker, saying, yes, we need to raise rates. What went on behind those closed doors today, do you think?
Good debate, I'm sure. A lot of people bringing information. I always respected the way the Fed presidents behaved and everybody at these meetings and the information they came with. It is an excellent meeting, and it's great that it's closed door and you don't have to be on camera and, in politics for the whole thing. So that is one thing I'm very impressed with the Fed, is the kind of deliberation that goes on. However, I just don't think anybody's really representing the view, that the well-thought-out view in this case, that we're in a liquidity trap. And the solution to it is to raise, if the low interest rates were the solution to a good economy, we would have been there already.
Yeah, but Kevin Hassett, I mean, how come 9 folks, these are smart people, said no rate hike right now?
Well, I mean, obviously they all voted that way because they disagree. But the fact is that the global economy is kind of falling apart. The Chinese economy is much worse than anyone expected. And the problem with setting prices, and make no mistake about it, in financial markets, the Fed's been setting bond prices for a long time, is that just like when we set gas prices, we had long lines and imbalances. Well, if you set prices in bond markets, even out into the intermediate and long term, then what happens is weird things start to happen. And one of the weird things that's happened is that developing countries have issued a whole bunch of dollar-denominated debt. And so if China continues to collapse and the dollar gets stronger, then you could end up with a massive financial crisis where all these developing countries start to default. And I would guess that that's the main fear that the Fed has right now.
That's what
but the point is that they've got to normalize rates.
Right.
But that means
they've got to normalize rates in order to get off of this. So we have to get through this period.
So what you're saying essentially is that the Fed has created all these bubbles that need to be popped through higher. I mean, listen, it's tough medicine. It's maybe not the best time to do it. They probably should have done it a year ago. But they kind of got to do it, right?
Yeah, well, and imagine if today, Maria.
Yeah.
Can I finish it? Just imagine if this is what happened. The Fed said, geez, the U.S. economy looks strong. It's approaching full employment. While inflation has ticked down, we expect that to reverse. And we're going to lift interest rates by 12.5 basis points today as we begin the slow and steady path to return to normal. If they had done that, I think markets would have celebrated.
Yeah, I agree.
Don't you?
100%.
Yeah, well, it would have sent a message that the economy is improving. But this message is that the economy is deteriorating.
But, Maria, I don't know if we should make a lot out of the 9-1 vote. And I'll tell you, because Martin Felsing said something interesting. Mm-hmm. You don't, generally, the quorum of the Fed is you don't want to vote against the chairwoman or the chairman.
Yeah.
And when you have one that does, well, then he's really pissed.
Yeah, that's a good point. Kevin Hassett, Michael Cox, thanks so much for joining us.